I'm Professor Gonzalez, and today we're going to go over solvency ratio. So what is solvency? Solvency is the ability of a company to pay long-term debt. So I have another video on current ratios. Current ratios have to do with short-term, solvency has to do with long-term. And when we look at ratios, I'm going to give you some guidelines, but always remember that you have to look at the industry that you're working with, because it may not follow the actual regular guidelines. Also, when we look at ratios, we don't look at them standalone. We always compare them to something. We may compare them to industry averages, which are published. We may compare them from year to year and see how they've changed. We may compare them to competition, or we may compare them to other department within a company. The first ratio is the debt ratio. The debt ratio is total liabilities divided by total assets. And both liabilities and assets are found on the balance sheet. And when we do this calculation, the result will be a percent. On this ratio, we want a lower result because the lower is less risky. It shows me how much of the assets are being financed by debt. A typical guideline is 100% or less is considered less risky. So less than 100% would be financed by debt. The next ratio is the debt to equity ratio. That ratio is calculated by taking total liabilities and dividing it by total equity. Both of those are found on the balance sheet. The debt to equity ratio is a rate. In general, the lower ratio is better, and it's showing me how the company is being financed. If it is a high ratio, it's being financed more by debt than equity, than ownership in the company. And remember, debt has to be paid back. The general guideline is 1.5 or less is considered less risky. So you can imagine if you're evaluating this company and if you come up with a rate of 3, you know that it's being financed more by debt than equity, which equity does not have to be paid back. The last ratio in this category is the times interest earned. This ratio is calculated by taking income before interest and income tax and dividing it by interest expense. This result is a rate, and in general, the higher ratio is better because that will show that the company has a better ability to pay back the interest on debt. And the guideline is a 2.0 or higher is less risky. These two items that are in this calculation are both found on the income statement. So now we're going to look at some examples. So the debt ratio and the debt to equity ratio, all the numbers we need are on the balance sheet. On the debt ratio, we're taking the total liabilities and dividing it by the total assets. So when you look at this balance sheet, it does not have a total on liabilities. There's multiple ways to do this calculation. You could take the total current liabilities of $430,000 and add the total long-term liabilities of $804. Or, as you can see in the calculation I've taken the total liabilities and equity of $3,602,000, and then I subtracted out the equity. And I divided it by the total assets. And the result is a percent, 34%. So that shows me that 34% of the assets are being financed with debt. The next one is the debt to equity ratio. This ratio, again, we're taking the total liabilities, and I've calculated the same as the debt ratio. And with this one, we're dividing it by the total equity, which is given on the balance sheet of the $2,368,000. And it comes to 0.52. The next ratio is the times interest earned ratio. All of these numbers come off of the income statement. So the numerator of the fraction of the calculation that we're doing is going to be income before interest and taxes. Now sometimes this can be a little bit tricky. Okay, so we're looking at the income statement. We have a line for income before taxes, and that's the $354,543. Now to get to that number, we had to subtract out interest expense. So to get income before the interest, I have to add that interest expense back, the $34,466. Keep in mind that sometimes you have to do the same thing for income tax if you are not given a line for income before taxes. And then we have divided it by the interest expense of $34,466 to get 11.29. And remember, this indicates how easily the company can pay back the interest on the debt. So those are the solvency ratios. Thank you very much. I hope this video has helped, and please click on the EdVantage logo to subscribe.